Are SPACs bad? Are SPACs a scummy asset class? Should you avoid SPACs at all costs? For me, I'm very cautious on them and the companies that get brought public. A few months ago, I called out to Journey subscribers, Unrivaled Investing Journey subscribers, that I think a SPAC bust could happen in the coming quarters. And sure enough, March 2021 started to look like that might have been happening or starting to play out. Now, sure, I do videos on SPACs all the time, but that's because I love learning about new companies. I love turning over rocks and looking for hidden treasure. And occasionally, in my opinion, I find it. I've even owned a few SPACs that have performed very well for my personal portfolio. Journey subscribers know all about those. Now, but broadly, I think SPAC investing can be a minefield for folks that don't know what they're doing. Step on a mine, blow off your leg or blow off your foot. You got to be really careful and got to know what you're doing. Now, what is the SPAC process? Just to make sure we're on the same page. The SPAC process is all about making it easier for companies to raise capital. This is private companies looking to go public, and it's done in a timely way, a very quick way relative to the IPO process. The IPO process will take months, can take a year or two, and you flesh everything out. It's run by dozens of lawyers. You make sure you get all your systems in place so that way you're ready to become a public company. And we'll talk more about that in a minute. And here it is, the SPAC process is sort of saying, hey, we've just brought this pile of cash public. So you have effectively this acquisition vehicle that's looking for a deal and will merge with this company or acquire a part of a private company and bring it public. Now, what happens when all of this happens? You get lofty guidance from management saying, hey, we have really rosy projections for the years ahead. Now, the reason why that is because you usually have management own or have some skin in the game, and the higher the valuation, the less diluted they get from doing a capital raise. So they want to put up guidance that looks really good. Next up, insiders of the SPAC get effectively a percentage or a couple percentage, get a piece of the pie for free, just for doing the deal, executing the deal. So they're heavily incentivized for getting a deal done, almost regardless of the valuation. They're willing to pay up more because they're effectively getting part of the company for free. That's very different from the SPAC investors. The last component, I would argue, is the bankers are getting really hefty commissions. So as long as you have all these different components working together, the bankers, the insiders, the SPAC investors, all looking at this, you're going to keep getting this parade. It'll keep on going on, and that's what's been going so far. But earlier today, the SEC started to show some signs of cracking down. The SEC posted 2 notices regarding SPACs, and this might just be the beginning of the SPAC bust, or the end of the SPAC boom. Maybe that's the right way to frame it. It's the end of the SPAC boom. So let me do a quick plug on what you're watching so that way you can know what is this? So my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. Normally, I'm trying to focus on potential multi-baggers, types of companies that can potentially go up hundreds or thousands of percent over time. And if you enjoy learning about those types of companies, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. And if you want to follow my personal journey as I'm looking for potential multi-baggers, go to unrivaledinvesting.com. Click on Journey. So what did the SEC post today? So this is the Securities and Exchange Commission. They regulate effectively stocks in the United States, saying, hey, this is what you're supposed to do. This is what's allowed. This is what we expect from you. And so there were 2 separate notices posted today. The first was the financial reporting and auditing considerations of companies merging with SPACs by Paul Munter, the acting chief accountant of the SEC. The next one was the staff statement on select issues pertaining to special purpose acquisition companies. Handful, if you got a full mouthful for both of these, what does it all mean? And the answer is that these companies need to get their stuff together. That's what it means. That's me reading it. This is how I summarize it. Get your stuff together. So let's boil this down to, Barney style, so everyone's on the same page. So you got to make sure you have financial reporting that makes sense. So you have systems in place so that way when you are a public company, yeah, when you're a private company, you can do whatever you want. You only have to meet the demands of your private owners. When you're a public company, now you got to meet the demands of the SEC, what they expect from you. And so that means you got to have processes in place to put together reasonable financial statements in a timely way. Next up, you got to have internal control. So that way it's very clear. Oh, who's doing this? What is the process for making this happen? Corporate governance. Okay, so let's clearly allocate who the different, what roles each person has, clearly define what's going to happen, who does it, so that way you don't have one person potentially, it's great. You need to have numbers and then have someone else double check it to make sure everything's, balancing and running correctly. What are the policies you're using for, let's say, basic accounting principles? How do you recognize revenue? Oh, are you doing it one way here and a different way there? You have to make sure you have your house in order before you can go public. Another aspect is audit committee. Okay, so what is the policies for selecting an auditor? What are the policies to make sure your financials are in good financial standing? Like, hey, these are financials that we would feel comfortable putting in front of an auditor that won't, that aren't messed up, and that we are fairly certain we can rely on in the months ahead to show to investors, saying, hey, this is actually what happened. Also, because the SPAC process involves sort of bringing a company public, you might need to have more than one auditor review your historic versus sort of forward projections, or your historic versus your current numbers, because oftentimes it involves a change in the underlying balance sheet of the company. I'm not doing this video to pick on any companies in particular. I just want to do this as illustrative examples. So let me go through two quick examples that sort of should be top of mind for potential investors in SPACs. So one of which is Tattooed Chef. TTCF is the stock. I did a video on Tattooed Chef several months ago before they officially de-SPACed or officially became public and started trading as Tattooed Chef. I actually like the company's mission statement. You'll get that from watching the video on it. I like the mission of bringing healthy and fun vegan food options to the marketplace, to the masses. I like the mission statement. I like what they're trying to do. But you got to get your stuff together, where here it is, within a few months of going public, in their annual filing, they report not one but 5 different material weaknesses. Now, material weaknesses are effectively way of saying, hey, we don't have our financial house in order for this reason. So let me share a couple of the different reasons. So they didn't have effective control environment commensurate with financial reporting requirements. That's one of the things you're expected. Design and maintenance of formal accounting policies, i.e. hey, this is how we're going to always treat our financials. So the more material weaknesses you have, the more uncertainty you might warrant when looking at a company's financials. Hey, will these financials need to be restated in the future? I would say that's a higher possibility given these dynamics. A third aspect, a third material weakness was saying, related to the lack of implementation and maintenance of appropriate information technology, general controls, including controls over data center. They're talking about access security, program changes. Another one, the segregation of duties with respect to the preparation and review of account reconciliations, as well as the creation and posting of manual journal entries. So this all gets back down to very basic. This gets back down to the SEC saying, look, you need to have your house in order. You need to be prepared to have financial statements. You need to have policies in place to do these things in a timely way. And it's a consistent policy from month to month, quarter to quarter. You have select people assigned to run these policies. The fifth material weakness of formal accounting policies regarding the ability to analyze and account for disclosed complex transactions. I mean, this is a perfect example of a reason why you might have to restate financials in the future is if you don't have the appropriate policies in place to deal with, let's say, a transaction that requires multiple different parties over multiple different times, the odds of having to restate definitely go up. So that's just dynamics that one needs to consider. That said, look, I applaud what they're doing. They're trying to get ahead of it. They recognize where they were. All companies need to start somewhere, and they're recognizing, look, these are the material weaknesses we've identified so far. Let's make ourselves better and address these in the future. So I applaud that initiative, but it does sort of reflect that they weren't really ready to go public yet. The fact that there were 5 different material weaknesses in their financials. That is sort of a red light. Now, if there's 1 or 2, I kind of understand, but like 5 is a lot. And there's room for more. So this is, so far I've sort of talked about what the SEC is expecting, like saying, hey, you have to have your financial house in order. You know, the one of their posts was effectively saying, look, here are the different forms that you need to fill out and which ones you can and cannot do in which time frame. But I think there's actually even more that the SEC can consider if they wanted to. Such as, let me give an example with XL Fleet, and they're a leading provider in fleet electrification solutions for commercial vehicles. I did a video on XL Fleet as well, and you know, here is an example of what their projections. This is from the presentation the video that I did on XL Fleet that's in YouTube. You know, I'll post a link to both Tattooed Chef and XL Fleet in the comments below. And, you know, you could see that they're projecting hyper growth acceleration, 192% growth in 2020. Okay, 2020 was mostly done, so they were locking that up. But then they were saying, hey, we're going to re-accelerate to 258% growth in 2021, going from 21 million in revenue to 75 million. I called out in the video on XL Fleet that I thought it was very, very tough for them to deliver it. It's always tough when a company has to deliver accelerating growth. I'm not making a call on what their mission is. I think electrification is a wonderful thing. Yes, I want cleaner environment and I'd like more electric vehicles. Thumbs up. That said, not all EV players are going to be winners. And so, you know, this is what management put out just a few months ago for investors to consider. So this is, you know, I ultimately didn't really, I looked at this, I said this is going to be really tough for them to deliver on, but ultimately I didn't like the setup. I thought the risk reward was just not good enough at the $10 share price or a slight premium to it. And I called that out in the video. I said, you know what, I just don't like this risk reward. And then what happened? Today, they posted that they're effectively removing their guidance for 2021. So fast forward just a couple of months, they're like, whoop, no, we're no longer looking at 21 guidance. So just a few months ago, they were willing to look out to 2024. Now it's 2021 is going to be too hard. And look, the stock has gotten beaten up to, you know, in the after trading today, the stock's down something like another 10%. It's down about 25%, you know, since I made that video when I called out that I didn't like the risk reward. You know, that's down effectively in a flat market, down 25%. And, you know, I look at this and, okay, so why are they pulling their guidance? Well, face ongoing impacts of the COVID-19 pandemic. That was something that was known a few months ago. But then they go, look, you know, we continue to experience significant friction, including OEM delays amid microchip and other shortages, original equipment manufacturer delays amid so like maybe, you know, new shortages with microchips, but it does sort of sound like it was tied to COVID and the pandemic. And then, you know, look, we are not currently providing formal full year 2021 financial guidance. You know, and then look, we expect our revenue to effectively grow more in the future. We expect to see a stronger market environment emerge later this year. In this scenario, we would expect to realize significant revenue growth in 2021, accompanied by even more pronounced seasonality, and therefore waiting to the second half of the year. I.e., it's going to be wait till the second half of the year when we put up good growth. But currently, we're expecting revenue of approximately 1 million for the first quarter, or roughly flat year over year. I mean, they were expecting the company to over 3x. I mean, and here it is. They're saying instead of 75 million, we're doing 1 million in the first quarter. 75 million was for the full year. But like, shouldn't there be some sort of consequence for this, in my opinion? Like, I feel like the incentives are screwed up. And this is where I wish that there might be some creative solution to sort of get everyone aligned. Like, maybe, and this is one idea I saw somewhere where, you know, wouldn't it be great if management isn't allowed to sell, and let's say the SPAC sponsors aren't allowed to sell for the duration of the forecast period. And I think that would probably solve part of this problem of sort of saying, you know what, if you're going to put guidance out to 2024, you're not allowed to sell until then. Because, hey, if you're actually going to deliver on that, your returns are probably going to be fantastic. But if not, and you're just going to mothball this, a couple months later. It's kind of it's messed up in my opinion. It misleads these retail investors. It misleads all these investors that are excited about the potential. They're excited about a story, and at the end of the day, they lose their shirt. They get burned again. The retail investor loses again, and so that's part of the reason why I want to call this out. Call this out that the SEC might just be beginning to break the SPAC boom. This might just be the end of it. So what is an investor to do? Recognizing that SPACs, it's an unconventional, it's an alternative way to bring companies public. So, and I'm not saying dismiss them all together. I'm not saying SPACs are bad. I think the incentives can be a little bit screwed up, but you got to know what you're doing, and you got to, figure, okay, well, if the incentives are screwed up, let's try to find a company where the guidance is conservative. Let's try to find a setup where management's actually going to raise guidance. And you know what? That's actually something I recently realized with my October 2020 potential multi-bagger. This is something that Unrivaled Investing Journey subscribers know about. That I for my October potential multi-bagger, it was both the common stock and the warrants. So I thought that they were actually sandbagging their projections. Most of the time, the projections are really hyper aggressive, and what ends up happening is they have to pull them. In this case, I said, you know what, there's a good chance that they're actually being too conservative. And, during that time period, the stock rallied like over 100%. And the warrants that I also bought went up something like 7x within a few months. So it was a great, it was a great ride while it happened. At that point, it was a little too rich for my taste. But since then, management has actually raised guidance. They were actually, our results for 2021, we're raising what we expect will happen. So I would say the first step is like the alternative to, this hyperbole of management's projections is to find something where it's like, this is reasonable. I actually think you can beat this. The next step, and this is what I mean by this is a minefield. You don't want to blow up. You got to know where you're stepping and try to avoid these types of situations. I can assure you the vast majority of SPACs do not raise guidance. Do not, we're going to, our 2021 figures we're raising. The vast majority, I think, are going to do what we just saw with XL Fleet, or do what we see, with the Tattooed Chef, where it's like, we just weren't really ready, and here's 5 material weaknesses, and who knows whether or not we'll have reliable financials in the period ahead. Hopefully they do. The next aspect is size up the risk reward for every investment. You can't just get excited about the thesis. You can't just say, hey, you know what, I just want to buy, this just because I'm excited about the electrification of vehicles, or hey, who knows who's on the, the board of this company, and, maybe they have a relationship to the current presidential administration and they'll definitely get these huge orders. Like, my view is like, size up the risk reward. Maybe take a discount to what management has to say. And like, if you can discount what management has to say and sort of use a rational approach, could you still get an adequate return? Could you still get a satisfactory or good return discounting what management has to say? And keep in mind, this is my sort of conservative approach to trying to find potential multi-baggers. In contrast, I mean, look, it's a marketplace. You're going to get people that say, hey, Daniel, you're being way too conservative. And there are some investment managers. I mean, look at the super famous Tesla models, and I've done one video on it. But, they're making assumptions that are even more aggressive than what management projects. So, like, if your thesis is dependent on projections that are better than management, which, like, I don't, it's flabbergasting to me. How often... what's the base rate for companies exceeding their lofty hyper projections? Like, if you're a company that's projecting above 40% growth, how often do they exceed it? Because I don't think it happens that often. Sure, companies will beat guidance from time to time, and they generally have a historic track record. But then I'm skeptical when it's like, hey, we're projecting, company expects 50% growth and you're expecting 80% growth. Then it's just like bananas. So that's the reason why you want to find reasonable risk reward. And by reasonable risk reward, what I mean is trying to find setups where it's like downside is immaterial or you don't think it's that significant, and try to find upside where it's like, oh yeah, I think I can make 100, 200%. And that's what I'm trying to call out each month with my potential multi-baggers, is sort of say, hey, this is something where the downside is reasonable and the upside is, hey, I like that potential risk reward. And that's how I personally think about it. So if this video has been helpful for you, seeing the SEC starting to crack down on that SPAC bust, please make a point of subscribing. If you want to follow my personal journey to see what I'm doing, go to unrivaledinvesting.com, click on journey, and each month I post what I buy, what I sell, what I hold. So that's the first week of the month I give a full portfolio update there. Then I go intermittent, interim updates for any time there's a material change in my portfolio. There's also an educational series. You can see the full exclusive catalog of content, everything that I post, in a link in the description of this video labeled catalog of contents, which each tab has a description for one of these things, like an educational series, portfolio updates. And at the end of the day, my goal is just to find one potential multi-bagger, the type of company that can potentially go up hundreds or thousands of %, because I truly believe that finding one potential multi-bagger can change your life journey. So if you're interested in following my life journey as I try to find these potential multi-baggers, go to unrivaledinvesting.com, click on journey, and thank you so much for watching.